98% of actively managed mutual funds underperform a single index, the S&P 500. In this video, we're going to be going through how you can outperform 98% of actively managed mutual funds with less work, less fees, absolutely made for beginners. We're going to be covering what are the best index funds for Fidelity, the optimal asset allocation, how to buy index funds through Fidelity, and finally, stay until the very end because I'm going to give you the free alternatives to these index funds that absolutely have no fees whatsoever involved. An index fund is a portfolio of stocks designed to track and mimic the performance of a financial markets index. For example, the S&P 500, the Dow Jones, it has a list of all these stocks. An index fund purchases bits of all these stocks and it allows you to diversify your portfolio with lower fees and lower costs than an actively managed mutual fund. These fees are a lot lower because instead of being actively picked by a fund manager, index funds literally just follow an algorithm, such as what are the top funds within the S&P 500, which significantly reduces the costs and fees that do add up. So for example, an index of the S&P 500 includes over 500 stocks, which really diversifies your portfolio. Now there are a couple of terms that we should look out for when we are analyzing index funds. The first one is going to be the expense ratio. If you actually start adding up the fees year over year, it can be significant. So for example, if you purchase $10,000 worth of shares of an index fund with an expense ratio of 1%, every single year you'd be paying 10,000 times 1%, which equals to $100 in fees. Now this might not seem like a significant amount of money, but imagine this carried out for the next 60 years. And of course, we're still imagining that you only have $10,000 into the account, which ideally you'd be consistently contributing more and more money. So that expense really adds up. We also want to look into the performance of the index fund year over year and see how does it perform to the average return of the stock market, which is 7%. Do take into account that past performance is not any indication of future performance. And finally, we want to look into what the actual portfolio or composition of this index is. We want to see if we're comfortable with the industries that these index funds are tracking, and if we're not, then maybe that's a way to stay away. And make sure you smash that subscribe button and ring the notification bell because it really helps with me making these videos. And without further ado, let's break the class ceiling. The first index fund I'm going to recommend is the Total Market Index, ticker symbol FSKAX. Now this index fund tracks over 3,000 companies within the stock market, which means that it's very diversified. However, let's actually dive into some of the terminologies that we were looking at. So this index fund has an expense ratio of 0.015%, which is actually really low. In the example I gave before, it was a 1% expense ratio. Now this is a fraction of that. Within the past 10 years, it has returned a 13.68% average annual return. This index fund actually outperforms the average return of the total stock market, which is a really great opportunity. Some of the top companies within this portfolio, I'm sure you've heard of them before, it's Microsoft, Apple, Amazon, Facebook, Berkshire Hathaway. The next index fund that I recommend is the International Index Fund, ticker symbol FSPS. In contrast to the total stock market, the International Index Fund tracks indexes of companies outside of the United States. So if you're interested in some international exposure, this might be a great opportunity for you. The expense ratio is slightly higher than the previous one with a 0.035%, which is still relatively low. Now, if you want a zero expense ratio, which means that you pay $0 every single year for these index funds, make sure you stay until the end of my video. That's where I'm going to be going over the free index fund alternatives that are essentially the same thing as these index funds. The performance of the past 10 years is 6.01%, and you want to take this into account when you are considering adding this to your portfolio and how that compares to the average total stock market and whether or not that really outweighs your desire to have a international exposure within your portfolio. Now, a couple of companies this index fund tracks: Nestle SA, Roche Holdings, Novartis, Toyota Motor Corp. So like some of these companies you've heard of because they do have exposure within the United States, but then they are internationally based. The next index fund that I recommend by Fidelity is the Total Bond Fund, ticker symbol FTBFX. And like the name implies, it follows US investment grade funds from the treasuries or mortgage-backed securities, etc. The past 10 years, the performance has been 4.51%. You do want to take into account that bonds usually underperform the 7% rule that we have, mostly because it is a lot more safe and a lot more secure than stocks. The expense ratio here is a little bit higher of 0.45%. And some of the top issuers that supply these bonds is going to be the United States Treasury, Fannie Mae, Ginnie Mae, etc. So a lot of these companies are very secured government entities. Now, the other Fidelity index funds that I recommend that I'm not going to do a dive into it is the Fidelity Small Cap Index, FSSVX, the Fidelity Mid Cap Index, which is FSCKX, and the real estate index, which is FSRVX. Now, again, these names are very literal, so you can understand what these funds actually track. Large cap is going to be just the largest companies within the United States. Small cap is the smaller companies within the United States. And finally, real estate, you're going to be tracking some real estate investments within the United States. And before we get into the optimal percent allocation to these funds, make sure you smash that like button, as well as comment down below which index fund are you looking into. Now, we recommend a very famous 3-fund portfolio made famous by Jack Bogle. It typically follows 3 main asset classes such as stocks, bonds, as well as international stocks. There are 3 simple levers that you can pull in order to make yourself comfortable given your risk tolerance. What I mean by that is that you can increase your stock allocation and decrease your bond allocation if you are more risky, and if you are a more conservative investor, you can do the opposite of that. Now, although it is a 3-fund portfolio, I actually recommend to turn it into a 2-fund portfolio and not actually invest in the international fund category. The reason for that is because the top US companies that you're getting from the total stock market already has exposure within the international markets. So it doesn't make too much sense to have international exposure from the total stock market, as well as specifically purely in international funds, because since we are in a global economy now, everything pretty much has a footprint everywhere inside the world. If you are a risky investor and you are relatively young, then I recommend 80-20, so 80% in stocks and 20% in bonds. If you're right in the middle, then 50% in stocks and 50% in bonds. And finally, if you are nearing retirement or you're a very conservative investor, then I recommend 80% in bonds and 20% in stocks. However, if you ask me, since I am relatively young at only 25 years old, I consider myself a very high risk investor, which means that I'm 100% in stocks right now. So I want to show you how you can actually buy index funds within Fidelity before we dive into the free versions of these index funds. So now we're going to transfer to my computer to see how this works. So right now we are on the total market index fund. What you want to do is click the buy button, and it'll bring you to this trading screen. You want to select the account that you want to invest in, and then you want to look into the actual mutual funds. So you see, put the ticker symbol if it's not already populated. You can see that it's $87.94 per share. So go to action buy, and I'm actually going to buy it live with you guys. So let's say you just want to invest $100 into this. You want to preview your order. It shows you this. Now you want to confirm that you want to place the order. So buying 100 shares of the total market index fund into your account. You want to place order, just simply click that, and it says order received, and you are going to be buying this. Eventually, you're going to receive an email confirmation depending on what time of day you purchase the index fund. It's usually going to go to a trade confirmation at the end of the day for most, if not all, index funds. For the actual free index funds, which means that there are no expense fees whatsoever year over year, which means that you can invest in these funds and pay $0 every year. A couple of them is the FZROX, which is the free equivalent of the total market. The next is the FZILX, which is the equivalent of the international market, and then FZIPX, which is a small and mid cap fund. Now, if you're interested in investing in just purely stocks, check out my video over here where it's a guide to how to invest in the stock market as a beginner.